Hi, everyone. We'll give everyone maybe another minute or so to go ahead and join, and then we'll get started. Here we go. Okay, let's go ahead and get started. So welcome everyone. My name is Suzanne Samid. I am a member of our sales development team and one of our trainers. We'll be going over training for FHA Streamline and VA IRRRLs today. I am training as well as I'm also an underwriter. So I'm going to apologize right now if I've upset you with any conditions in the last couple of months. It was not personal. I also want to introduce my fabulous team. So I have Mariah Anderson and Heather Blands. They're also training and support specialists. And then I also have Janet McLeish, who is our senior underwriter, one of my personal favorite underwriters. And she is very well versed in government refinancing. So she'll be able to ask some of these in-depth questions. Okay, so let's go ahead and get this party started. So today we are going to simplify your lives. We're going to stress less, save more with a streamlined mortgage option with Sierra Pacific Mortgage. We're going to reduce, refinance, and relax. So definitely need to relax after the last couple of months. We need some easy loans, right? Real quick, just to note that this is an overview of your FHA Streamline and your VA IRRRL programs offered by Sierra Pacific Mortgage. Both of the FHA Streamline options and your VA IRRRL are government programs. And then if a conflict arises between my training presentation and the guides, I'm always right. Okay, fine, the guides are always right. So go ahead and always refer back to those. And then this training is prepared for informational use, and the information is confidential and proprietary and is subject to change without notice. Okay. All right, so let's jump right in. So first we're gonna go right into our FHA Streamline. Okay, so some real quick need to knows. There is a reduced admin fee of $4.95. No appraisal, no CAFers. There's no DTI ratio on your non-credit qualifying Streamline option. It's only for primary residence. And just note that there is documentation required to support our occupancy. So that would be the form of utility bills, employment, income documentation, etc. We do have a minimum credit score of a 620. We do have two terms available, which is your 15-year and your 30-year. And then we do also have 12 months payment history required, and that's to reflect that there's no 30-day lates in your most recent 12 months. For a non-credit qualifying option, a mortgage-only credit report's required. I'll dive into that shortly. For a credit qualifying option, a full tri-merge credit report is required. Impound accounts are required, and then there's a maximum loan term, which is going to be the lesser of your remaining term plus 12 years or 30 years. I'll also dive into that further as well. Eligible property types include a single family residence, PUDs, modular homes, 2 to 4 units, and condos. Funds to close that are less than 1 month PITIA, we don't have to document those assets. So of course, if the cash to close is greater than your PITIA, we would have to verify those assets. Maximum cash back is $500. One thing with your FHA Streamline is that closing costs are required out of pocket. So that's kind of your only downside with an FHA Streamline option. But just note, as we get further into this market, we can offer a higher interest rate for that rebate pricing to either offset or eliminate those closing costs for that borrower. There is also a seasoning requirement, which is 6 months and 210 days. I'll dive into that. And then super important, we need a complete application. So these streamlined refinances come around every couple of years, and it's kind of the low-hanging fruit. So we've spent the last few years doing really difficult loans. These loans are going to be a lot easier, but the way that this works is we take that full complete application initially, and provide all of that information to our underwriters so that we're not having to go back and forth with additional documentation requests or to clarify any of our subject property information, et cetera. I do want to note that in our proprietary system, Express Loan, currently you guys have to enter $1 into your income in order to proceed with the application. I just want to let you know that that's going to be short term. We do have a fix coming in our October release for that. So just for the next 30 days or so, you'll be entering in that $1, okay? And then super important, if you guys take nothing else away from today, note that we do not run our automated underwriting systems. So not for credit qualifying, non-credit qualifying, your IRRRL, we're not pushing that button, okay? Then I wanted to go ahead and give you guys this slide. I've created this presentation so that you can refer back to it. This will be provided to you today after our training, as well as any worksheets, any job aids that I share during this training. We'll share it with your AEs, who will then go ahead and share that with you. But this is meant for you guys to come back to. So I don't expect you to absorb everything today, especially with multitasking with all those calls from borrowers, I'm sure. But a question that we do get fairly often is what's the difference between a streamline refinance and a simple refinance and a regular rate and term? So for a streamline, it's going to be simplified refinance process. And this is for existing FHA loan holders. Your requirements are that it's minimal documentation, no appraisal needed, and no credit check for non-credit qualifying streamline refinances. Benefits are that it's faster, potentially less expensive than traditional refinancing. Your FHA Streamline must result in a net tangible benefit to the borrower, and it's only available to an existing FHA borrower. And of course, none of these can be used for cash out. That would be your regular cash out refinance. Your FHA Simple refinance is also going to be for an existing FHA loan. So it's FHA to FHA again. This does require a new appraisal and a credit check. And then your benefits are that it's flexible terms are allowed and it's not restricted to a specific net benefit like your Streamline is. Also, you can add in the closing costs and prepaid costs into the loan as long as our maximum LTV stays below that 97.75. Limitation, it's a little bit more documentation, potentially higher cost compared to a Streamline. Your FHA rate and term refinance. So again, that's just designed to lower your rate term. Again, you can't take out any equity, so no cash out. This also requires a new appraisal and a credit check. This is, however, available to an existing FHA borrower as well as conventional. So if someone currently has a conventional loan, they can do your regular FHA rate and term to go into a new FHA loan. So your benefits, just like your others, it can lower your monthly payment or total interest paid over the life of the loan. Limitations, again, you can't do a cash out, and then more documentation is required compared to a streamline refinance. For your comparison summary, so your FHA Streamline requires the lease followed by a simple refinance and a rate and term refinance. An appraisal is not needed for the FHA Streamline, but it is required for your simple and your regular rate and term. Credit check, not needed for that non-credit qualifying Streamline. It is required for a credit qualifying Streamline, an FHA simple, and the FHA rate and term. Flexibility, your simple and your rate and term are going to offer more flexibility in terms. As far as eligibility, your FHA Streamline and your FHA Simples for existing FHA loans, while the rate and term can be used for FHA conventional mortgages as well. Ladies, do we have any questions or anything you need me to go over? Good. All right.
Suzanne, can you go over what non-credit qualifying is for the group?
Yeah, so I'm going to go into further detail and break out the difference between non-credit qualifying and credit qualifying. So we'll see that in just a second. One thing I did want to note is that you guys, when we were going over that need to know, you were probably wondering, why is a mortgage only credit report required? HUD doesn't require that with these. So again, here at Sierra Pacific, we do have a minimum credit score of a 620. And then FHA does actually require that we document that the borrower's mortgage payments are made in the month due. So the easiest way to do that is by obtaining a mortgage only credit report. And I do want to let you guys know that I will be very transparent about any of our overlays. So if something is an overlay, I will absolutely call it out and let you know why. Okay, and then ask and you shall receive. So non-credit qualifying streamline refinance. So this one, there's no credit report. Big thing to note with this though is your borrower eligibility. So you can add an individual to title or to the mortgage on non-credit qualifying, and they don't require credit worthiness review. Typically, you can't remove borrowers with this option. You can remove them under the death or divorce exception. So that would require a death certificate and divorce decree. And in addition to that, the remaining borrower will need to document the most recent 6 months payment made in the month due prior to case assignment. So super important, your case assignment, you want to make sure that your housing payment history, any of your seasoning requirements are prior to that case assignment. So before you guys go in and request that, make sure we've got all the ducks in a row. Again, no appraisal required. There's no income. A verification of employment is still, however, required. We just need to make sure that the borrower is employed before we close the loan. There's no calculation of your DTI, which means no compensating factors. I'll get into that for you guys. Any delinquent federal tax debt or non-tax debt doesn't come into play unless it comes up with title. If it's going to impact our lien position, then we would have to go there. But if it's nowhere on title, we don't need to go there, which is nice. Again, that mortgage-only credit report's required. And then the mortgage payment history is to reflect 0 30-day lates in the most recent 12 months. That is our own overlay. So HUD only requires 6 months. We take that a step further for 12. And you might be saying, Suzanne, what if the mortgage is only in existence for 9 months? Then what do? Then we just verify that mortgage history. So it's going to be a minimum of 6 months and then up to 12 based on the age of your actual loan. Also, we don't allow the streamline with a borrower who's in an active bankruptcy, and then we do not allow manufactured homes. Okay, and then again, super important, non-credit qualifying, we're not running that AUS. Then real quick to go through your credit qualifying streamline. So with this one, at least one borrower from the existing mortgage must remain as a borrower on the new loan. You can remove borrowers. So the thought process is with the non-credit qualifying, you can add borrowers and there's no risk because whoever is currently on that mortgage has been making those payments. If we're removing somebody from the existing mortgage, that could be removing employment or income that is necessary to make these payments. So this is why the credit qualifying streamline requires these additional documentation. I do want to note that it's all manual underwriting. So again, we're not running AUS. Something that everybody forgets, including myself as an underwriter at times, is that with a manual underwrite, it does require a minimum of 1 month PITIA for 1 to 2 unit properties, and then 3 to 4 is going to be 3 months of PITIA after closing. So that's in addition to the rest of your manual underwriting guidelines, such as your full credit report, so that's a full tri-merge, your income documentation, asset documentation if applicable, and then your debt to income ratio with compensating factors, which I'll get into again as well. And then again, just calling out those overlays, so that mortgage payment history, the no active bankruptcy, and no manufactured homes allowed. And before I jump further, Mariah, do we have anything else to discuss?
We are good so far.
Okay, cool. So next, this is again your credit qualifying. So you heard me discuss your ratio requirements and then compensating factors. So again, you guys can refer back to this as a job aid. These are the things that we get the most questions on for sales support or even in underwriting. So here you're going to see your qualifying maximum ratio. So for anybody newer to the business, your front end ratio is going to be your housing ratio. That back end ratio is your total debt to income ratio. So this column is basically saying that, you know, if your borrower has 31 over 43, those are solid ratios for an FHA loan and no compensating factors are required. However, if I skip down here to 40 over 40, it says no discretionary debt. And you're probably wondering, Suzanne, what the heck does no discretionary debt mean? So I'll bounce forward for a second. I broke out your compensating factors and I am elaborating a little bit further on some of the ones we get the most questions on. So for example, that no discretionary debt, That one requires that the borrower's housing payment is the only open account with an outstanding balance. It's not paid off monthly. Credit report shows an established credit line in the borrower's name has been open for at least 6 months, and the borrower can document that these accounts have been paid off monthly in full for at least the past 6 months. Okay, so if I go back here, if we look at your 40 over 50, you'll see that now your acceptable compensating factors goes to 2 of the following. So they want either reserves, minimal increase in housing payment, significant additional income that's not reflected in your qualifying income. So that could be maybe your underwriter isn't able to use a certain amount of income, like maybe bonus or overtime, based on those guideline requirements, but we can see that that borrower still has that income coming in. We can use that as your compensating factor for significant additional income. And then another one we get a lot of questions on is your residual income. So if I go back over to this slide, you'll see residual, and I've broken it out for examples as far as what residual income might be. So state and federal income tax refunds, job-related expenses, that kind of stuff, okay? Then next, I just want to go over your streamline seasoning requirements. So you guys are going to see this a lot, and you're probably going to be annoyed at the end of the presentation. So I'll go through this now, and then when we go through it, I'll just let you know that this is what we're talking about again. So super important, again, on the date of the FHA case number assignment, we need to document that at least 6 full months payments have been made since the first payment due date, and 210 days must have passed from the closing date. Your closing date is always going to be your note date. And then of course, if the borrower assumed a mortgage and they're refinancing, we'll need to document that they've made those 6 months payment since the time of the assumption. Note that an existing note will always be required to document seasoning. Few reasons we want the note. So it's going to show your note date, it's going to show your first payment due date, it's going to show your rate, and then very important, it's going to show your borrowers. So then that way we know, are we doing a credit qualifying or a non-credit qualifying? Are we changing any of the borrows? And then I have added a handy dandy link that we use in underwriting to go ahead and calculate these figures for your 6 months and then your 210 days. And then there is a payment history requirement, so a little redundant. Borrower must have made all mortgage payments for all mortgages on the subject property within the month due for 6 months prior to case assignment and have no 30-day late payments for the previous 6 months on all mortgages on the subject property. So again, if it's going to be greater than 6 months mortgage history, we want to go up to 12. Anything that's less than 6 months would not be eligible. So that is actually a HUD requirement that they have at least 6 months payments. And then also note, they can't prepay this. So if your mortgage payment is due in August, it has to be made in August. If it's due in September, it has to be made in September. Okay. Any questions that I need to go over, Mariah, or back up on anything?
Can you go over what happens if they cannot locate the note?
Janet, can you think of, I mean, I guess if we got statements, but we would have to, your refinance authorization will show your original loan amount. Janet, can you think of anything else that they can provide outside of the note? Oh, Janet, you're on mute. That pesky mute button.
Am I off on mute now?
Can you hear me now? Good now. Yeah.
Typically the note is required to ensure that both that we can confirm that no borrower is coming off the FHA Streamline. So I think that, you know, like a case-by-case basis, you'd have to work with the underwriter to confirm that. You know, a mortgage statement should show both the borrower's name. The deed of trust should show both borrowers' names. The note is, you know, really critical for that, you know, that plus to know exactly when the first payment was made.
Right.
But yeah, that is kind of a tough one to overcome, but I'm sure we could work with people on that.
Okay, awesome.
Or they could, their actual, like we would be able to provide a note to the borrower if we were servicing their loan. So I'd imagine everything we can.
Yes, of course.
Yeah. If it was a Sierra one, we can just go into the old loan and grab it. Yeah.
Right. Right.
But like, yeah, so they have to go to their old servicer, which would open them reaching out to the competitor, I guess, at that point, but they should be able to pull it somewhere. So I guess if that comes off, just let us know and we'll help you find it.
Yes, we will absolutely look into it for you guys. Okay, thank you, ladies. Oops. All right. Next, with your FHA Streamline, there is a maximum loan amount requirement. So it's a lot of underwriting math. I have worksheets for you guys that make life a little bit easier, as well as some examples of a refinance authorization and a payoff statement. So for your maximum mortgage calculation, it's going to be the lesser of two calculations. So the first one is your original principal balance of the existing mortgage, which includes your finance upfront mortgage insurance premium less the refund. Then your second calculation is going to be the outstanding principal balance of the existing mortgage as of the month prior to disbursement, plus your interest due, monthly MIP, suspended payments, which could be a result of a COVID-19 forbearance, late charges, escrow shortages, and your MIP due on the existing mortgage. So the next few slides I have will go through like this specific calculation and examples for you guys. I do just want to note real quick on your excess cash back. So we had discussed in the need to know section that it's a maximum of 500. Sometimes you're going to have a little bit more than 500. So wiggle room you have is that the borrower can get 500 and then another 500 can be applied towards a principal reduction. So that's a total of 1,000. If the total is going to be greater than 1,000, at that point, the loan would need to be returned back to the underwriter in order to recalculate our maximum loan amount. And then your required documentation, we need the payoff statement in order to do some of these calculations. So here is that worksheet. Again, I'll be sharing this with you guys. So it has your original loan amount calculation and then your existing loan max calculation. So over here, you've got calculation 1. So that's your original mortgage amount from a refi authorization. Refi authorization comes from FHA Connection. So that's where you're going for your case assignment, all that good stuff. 1B is going to be your unearned upfront mortgage insurance premium from the refi authorization. And then calculation number 2, you're going to use 2A from your payoff, 2B from your payoff, 2C should also be from your payoff, and then 2D, we don't think we're going to have too many of those unless the borrower has an older COVID deferment. And then 2G, if it's present on your payoff, and then 2H, again, is from your refinance authorization. And once you complete these fields, 3, 4, and 5 are going to auto-populate for you. So here is just a quick screenshot of your refinance authorization. So a question that comes up a lot is, there's no appraisal, what the heck do I use for the appraised value? So that's going to be your original property value, which you could obtain here. It also gives you your original mortgage amount. And then super important is calculations are going to be done based off of the month that we're closing in. So for example, with this one, we've got the new month closing could be November or December. So based on when we're going to close our loan is what all of our calculations are going to be based on. So for this example, the unearned upfront mortgage insurance premium, we'll say is going to be from December. Our loan has to close in December. It would be that $2,288.92. Okay. And then here is that example. So we've got your refinance authorization to the right and our worksheet to the left. So you could see in our calculation 1 where that information is being pulled from. So over here, we're saying that we're going to close in August. So that figure of your upfront mortgage insurance premium, so less any refund, is going to be this figure. These figures, again, we're pulling from our payoff. And then again here, less any refund of your upfront mortgage insurance premium. So that's being pulled from here. So just note that your underwriter is going to set a must fund by date condition based on this refinance authorization. If the loan does not fund in the month identified, it has to be returned to the underwriter to recalculate the loan amount. So super important. If this example, say we were supposed to close in August, but it rolls to September, we have to do 2 things. We need to verify verify that that August payment has been made because the loan must be current at time of disbursement. And then we also need to pull an updated refinance authorization and recalculate the mortgage, your maximum mortgage amount. Okay. And then here is that example of your payoff statement. So where you are pulling these figures from, so it's your interest due, your principal balance, and then your MIP due on the existing mortgage. So these figures are coming here and going straight over here. And then you can see in this example, so it's saying calculation 1 is going to be the lesser of the two. And then 4 is adding that upfront mortgage insurance premium for the new loan. And then 5 is going to be your new gross loan amount. So this is going to be our maximum loan amount. Janet, do you want to add anything, or ladies, are there any questions, anything I need to back up with? Good?
We are good.
Okay. Okay, awesome. Okay, next, don't panic. We have a worksheet for this as well. There is a net tangible benefit with a FHA Streamline. So you're asking, Suzanne, what the heck is the net tangible benefit? So it's a reduced combined rate, a change from an ARM to a fixed rate, and or a reduced term that results in a financial benefit to the borrower. Then your combined rate refers to the interest rate on the mortgage plus the mortgage insurance premium rate. Then a reduction in term refers to the reduction of the remaining amortization period of the existing mortgage. So in this top chart here, I have for you guys, this will show a refinance without a term reduction or with a term reduction less than 3 years. So at Sierra Pacific, we do not do any streamline ARMs. So the majority of the ones that we're going to see are typically going to be coming from a fixed rate and going to a fixed rate. So for that new combined rate, it has to be at least 0.5% points below the prior combined rate. Okay. Again, we've got a worksheet, don't panic. And then the next chart down is for refinances with a term reduction of 3 years or greater. So just note with this that additionally the combined principal interest and mortgage insurance premium payment on the new mortgage must not exceed the combined principal interest and MIP payments on the refinanced mortgage by more than $50. So again, here you could see the chart going from a fixed rate to a fixed rate, says below the prior combined rate. And then if you've got an ARM with less than or greater than, you're looking at no more than 2 percentage points above the prior combined rate. So you're saying, where the heck do I get the combined rate? So on your existing, your refinance authorization, you'll find your existing MIP rate. So it'll show your original annual MIP factor. And then here, that's going to be your 0.55. And then this chart here can be found in your guidelines section, and it's in the mortgage insurance tab. And then here you've got your base loan amount, your LTV, and then it will give you your MIP factor and your duration. Okay. So here's that worksheet. So it will compare your existing to your proposed. So in this case, we're going from a fixed to a fixed. It was a 30-year to a 30-year. We're calculating that term. It does have the note here to remind you of that 12-year requirement. So say our existing term is now 352 months plus 12. So it's basically letting us know that your 364 in your existing is going to be greater than that 360. So our term would be the 360. Then it's got your existing payment and your proposed payment. And then it's got your interest rate breakdown. So this is where you can see that combined rate. So it has your existing interest rate at 7.625, and we're going to 6.625. Our monthly MIP rate is going to be 0.55. So that was from our refinance authorization to what we looked up in guides based on our new loan terms and calculation. So that gives us a combined rate going from 8.175 to 7.175. So that's going to be a difference of 1. So we would say this example meets our net benefit requirement for the combined rate to be reduced by at least 0.5 when the streamline refinance is coming from a fixed rate to a fixed rate. Okay. And then last but not least, we don't want to leave out beautiful state of Texas. So you can do an FHA Streamline in the state of Texas. Just note that it's going to be subject to additional restrictions such as your Texas regulations. So in addition to your FHA and Ginnie Mae requirements, the following applies. The existing FHA loan can't be a Texas A6. So that's that Texas cash out. We can't refinance that with a, FHA Streamline option. And then with FHA Streamline, it also says that there's no cash back to the borrower. So that's not even a dollar can go back to the borrower. So again, in this case, all incidental cash back can be applied to a principal reduction up to $1,000. Anything greater than $1,000 requires it goes back to your underwriter to recalculate that loan amount. All right, so that's it for the FHA Streamlines. Do we have any questions before I jump over to the VA IRRRLs? No? Everybody's okay? Okay, awesome. Okay, VA IRRRLs. All right, so here's your need to know. Again, super important. We're not running our automated underwriting system. That's going to be a no-no. Reduced admin fee of $495. No appraisal, no DTI. Again, primary residence only. Minimum FICO of a 620. This does come in terms of 15, 20, and a 30-year. And then it's going to be 12 months payment history reflecting those 0 30-day lates. Mortgage-only credit reports required. Eligible property types are the same in a single family, PUD, modular, 2 to 4 units, and condos. Your maximum loan term is the original term of the VA loan being refinanced plus 10 years. It cannot exceed 30 years and 32 days, very specific. There's also a net tangible benefit. So the refinance loan's interest rate must not be less than 0.5% lower than the fixed rate of the loan being refinanced. We'll dig deeper there. Again, you see that seasoning requirement of 6 months and 210 days. And again, we need that complete application, super important. Another thing to note is what the heck is a VA IRRRL? So if you haven't been in the business long, or maybe you haven't seen these type of refis with our recent market, it's a VA interest rate reduction refinance loan. Okay. Then the next 2 slides I have put together for you guys to refer back to as kind of a quick guide with all of the eligibility requirements. So I'll go through some of these. I won't do all of them. I know everybody's very busy. So your general eligibility requirements, a note that your certificate eligibility or COE is not required on IRRRLs. Just note that a surviving spouse who is a co-borrower under an existing an existing VA guaranteed loan is eligible for an IRRRL to refinance the VA guaranteed loan. Your COE should be ordered in the deceased veteran's name and social security number. Then you've got your Ginnie Mae seasoning requirements and your VA seasoning requirements. So again, that's your 6 months payment and your 210 days. The IRRRL does have a recoupment period for all allowable fees and charges financed as a part of the loan are paid at closing, and it cannot exceed 36 months. We have a handy dandy worksheet for that as well, and I'll be going into that in further detail. So the proposed Streamline refinance does not increase the principal balance outstanding on the prior existing residential mortgage, except to the extent of fees and charges allowed by VA. Your total points and fees payable in connection with the proposed Streamline refinance loan are in compliance with all of VA's allowable fees and charges. Again, that net tangible benefit, and it's a loan that provides a net tangible benefit, means that it is in the financial interest of the veteran. The proposed Streamline refinance is subject to a payment schedule that will fully amortize the IRRRL in accordance with all VA regulations. The terms of the proposed Streamline refinance do not result in a balloon payment, and both the residential mortgage loan being refinanced and proposed Streamline refinance satisfy all of VA requirements. There's also going to be a loan comparison and disclosure requirement. I'll go into detail on that. And again, all mortgage payments must be made in the most recent 12 months with no 30-day lates. That is our overlay. And the existing VA loan must be current, so it's due for the month it's closing in. IRRRLs that are 30 days past due require VA prior approval and are not eligible with SPM. Borrowers cannot currently be in a bankruptcy, and that includes a Chapter 13. Okay. And then here, that's that maximum cash back again. So they can get 500, and then another 500 can be applied to that principal reduction. If it's greater than 1,000, it's going to go back to your underwriter. There is also a maximum loan amount, and that is determined by an IRRRL worksheet that I'll be showing you. And then for the maximum loan term, again, that's going to be your original term of the VA loan being refinanced plus 10 years, but it cannot exceed 30 years and 32 days. So for example, if the old loan was made with a 15-year term, the term of the new loan cannot exceed 25 years. Okay, so those are the super important bullet points with your general eligibility. And then here's that seasoning requirement. So again, same thing, due date of the first monthly payment of the loan being refinanced is 210 days or more prior to the closing date of the refinance loan, and 6 consecutive monthly payments have been made on the loan being refinanced. So on this one, I just kind of spelled out an example. So let's say the loan being refinanced closed on March 8th. The first payment due date is May 1st. So if the veteran makes 6 consecutive monthly payments, the loan being refinanced will be seasoned on November 27th of 2024. And again, I added that link for your handy dandy calculator. And then here's that maximum loan amount worksheet. So the maximum loan amount is calculated using your IRRRL worksheet, and it includes the outstanding principal balance. It includes your late charges, escrow shortages, fees, payoff lender charges, etc., any allowable fees and charges, and your VA funding fee. So just note that this will be completed by the underwriter once they have the payoff in the CD. So if you guys are trying to jam these through, you may want to get that payoff before you submit to underwriting so that we've got all of our ducks in a row and we can move this out as soon as possible and you could focus on your next loan. Then I've got your IRRRL eligible transactions. So typically the parties that are obligated on the original loan must be on the new loan. There are examples of times that isn't happening and it's acceptable. So we can do an IRRRL. So if we look here at this top example, an unmarried veteran is on the old VA loan, and now we've got a veteran and a new spouse for our proposed new loan. Is that eligible for an IRRRL? So over here, yes, it is. So if we hop down here, here's one that's a no. So it's a veteran and spouse on the old loan, and now there's a divorce and it's just the spouse alone. No, I'm sorry, you're not eligible for an IRRRL. So this comes in really handy. We get a lot of questions on this, so I wanted to make sure I provided this for you guys. And then before I jump into the loan comparison disclosure, any questions, ladies? No?
No, we are good.
Good deal, thank you. Okay, so loan comparison disclosure. So within Express Loan, so that's our proprietary system, there's a tab for FHA, VA, and USDA. And it has your previous loan section, which is referring back to your existing loan that's going to be paid off. So the data that's entered into Express Loan, we can't stress this enough, it must be accurate as it's going to generate on your initial loan comparison disclosure in your disclosure package. So I've just provided a screenshot of the information that's going to be required within Express Loan, and then how that's going to look on your VA interest rate reduction refinancing loan comparison statement. Okay, and then this one's super fun. So there's the recoupment for the loan comparison disclosure calculation. So this is going to show the recoupment period in months for your total closing costs. And this is going to include your VA funding fee, escrow, prepaids, and this is whether it's included the loan or paid outside of closing. So note that this recoupment calculation is for the purposes of the loan comparison disclosure statement. It differs from the statutory recoupment calculation, and this calculation is going to gauge how the veteran's payments of taxes, amounts held in escrow, and fees paid affect the cost of the new refinance. So again, recoupment describes the length of time it takes, and the recoupment standard applies to all IRRRLs, and this includes but is not limited to IRRRLs where the principal balance is increasing, the term of the loan is decreasing, or where the loan refinance is in an adjustable rate mortgage. So that's your ARM. all VA IRRRLs must meet the statutory recoupment calculation of 36 months or less. So I'll show you guys that on the next slide. Just note, for an IRRRL that results in the same or higher monthly P&I payment, the veteran has incurred no fees, closing costs, or expenses, and the total closing cost for the initial loan comparison disclosure should match or be close to the amount disclosed on your initial LE, which is found on line J. And then for your total closing costs for the final loan comparison disclosure, again, it should match or be less than the amount disclosed on the final CD line J. Okay, and then here's that fun recoupment. So all VA loans are required to meet the 36-month statutory recoupment requirement. VA IRRRL loans with a recoupment greater than 36 months are ineligible. So for an IRRRL that results in a lower monthly payment, the recoupment period of the fees, closing costs, and expenses cannot exceed that 36 months from the date of the loan closing. Again, loan closing is your note date. For an IRRRL that results in the same or higher monthly P&I payment, the veteran has incurred no fees, closing costs, or expenses other than taxes, amount held in escrow, and then fees. Your recoupment must always be zero when the P&I is not decreasing. So here's your calculation. I won't go through all of that, but then here's this worksheet. And then just note that your VA underwriter is to complete this worksheet. Janet, is there anything that you want to add to this? I'm going to take that as a no. Oh, there you go.
Sorry.
That
I have
pesky mute button every time.
I have like 3 screens and it goes dark when I move into something. But no, I think this is the one, recoupment is the key. You really need to kind of nail those closing costs. And that's why, within underwriting, you'll see the underwriter condition for basically a final CD before they can actually issue the final approval. Because it's kind of a moving target on that. So the more precise we are with the closing costs, the easier the process will go for everybody.
Awesome. Thank you, Janet. Okay. And then we've got our super fun net tangible benefit. So when you're going from a fixed rate to a fixed rate, so the refinance loan's interest rate must not be less than that 0.5 or your 50 basis points lower than the interest rate of the loan being refinanced. So that one's pretty easy. And then for example, so the interest rate of the loan being refinanced is say 3.75%, it's fixed, then the interest rate of the refinance loan may not be greater than 3.25%. And then a note, we do not offer any ARM IRRRLs at this time, so we're just going to be fixed to fixed. And then here's just an example of that net tangible benefit worksheet that's going to populate with your disclosures. Okay, and then last but not least, beautiful state of Texas again. So we can do an IRRRL in Texas. It is subject to additional restrictions, such as your Texas regulations. And then if there's a conflict, the most restrictive guidelines are going to supersede. So again, in addition to VA and Ginnie Mae requirements, the following would apply. Again, we can't pay off that Texas equity, which is your cash out A6. And then there's no cash back to the veteran, same thing. Anything less than 1,000 is going to get applied as a principal reduction. And then anything over that is going to be returned to your underwriter. Okay. So before I start handing out gift cards for participation, ladies, do we have any other questions, comments, concerns that we need to address?
So far, we are good. We'll send everything out after this meeting. If you guys don't know who your AE is, feel free to reach out to tposales@spmc.com and we can get you in touch with them.
Awesome. Thank you, Mariah. And then we're doing just the Q&A in the chat. I'm wondering if this will work. So if I am asking follow-up questions, can they all respond so that I can send some people some gift cards? Can you guys tell? Heather, you're muted. Can you tell? So if I ask a question, can they all respond?
You should be good.
Okay. All right, cool. So I know you guys have probably all been multitasking. We're very busy people, but what is the number one thing you should not do on an FHA Streamline or a VA IRRRL? And so first one to respond is going to receive a gift card from yours truly, and I would just need your email address.
I did open up the chat as well, if it's easier.
Thank you, Jessica.
Put your responses in the chat and we can use that feature rather than the Q&A.
Awesome. All right, ladies, do we already have an answer? Oh, I see them over here now. Yep, we got a lot. All right, first person who responded, you're getting a gift card and I just need your email address. Next question, how many months do we need to verify that the borrowers had 0 30-day lates in order to do your loan with Sierra Pacific Mortgage? Look at that, I'm so proud of you guys. All right, and last but not least, who is your favorite training team from Sierra Pacific Mortgage? Yeah, love you guys. All right, guys, that is it for today. If you have any questions or concerns, please don't hesitate to reach out to your AEs. We have a wonderful group of very knowledgeable AEs here. And then just so you know, behind them is our entire team. And we care very much about your business, your reputation, and of course, your borrowers. So every loan counts, and we truly want to make things work. So I hope you guys all have a wonderful day. If you have any questions, concerns, need anything at all, please don't hesitate to reach out. Thank you.